Hello, agentpreneurs, and welcome to episode 114 of the Daily List Report. My goodness, I can't believe it's 114 episodes in. While you're here, if you like this channel, if you've seen great content, please consider subscribing. Click the little bell so you don't miss a single episode. Today, we've got one of my absolute all-time favorite guests back on the show, Rick Sharga. He's in a new role now. He's Executive Vice President at RealtyTrac. You hopefully have seen all of our episodes with him. Gosh, we had him on talking about work from home, the impact on real estate. That was episode 59. He was on early when we were just a fledgling show about developing a competitive advantage. That was episode 17. We'll link to both of those below. Rick is a frequent speaker. He has a wonderful background. He was previously an executive vice president at Carrington Mortgage. He was the chief marketing officer of 10X. And honestly, he's a delightful guy to talk to, and he knows all about what's happening from a data perspective in the market. And so without further ado, let's bring him on right now. Rick, welcome back to the show.
Thank you for having me again, Randy. Always a pleasure to be here.
Oh, likewise. I love talking to you, Rick, because you're like an encyclopedia. You know what's going on. And I feel like anything I ask you, you have a perspective on. So, Rick, you're back in you're in a new role, right? So, I've known you for a long time. Why don't you just talk a little bit about what you're doing right now? Because I love when our guests get a chance to get to know our guests, especially regulars.
Well, thank you. Yeah, I'm actually in a new old role. I've gone back to a company I worked with for better part of a decade until 2011, a company called RealtyTrac, and RealtyTrac has the nation's largest database of information on properties in various stages of foreclosure. We target real estate investors and real estate agents who are interested in finding out that kind of information. And in the role there, I'm responsible for marketing and industry relations, and it's an interesting place to be at this point in the housing cycle, as it's very likely we're going to see a little bit of an increase in delinquencies and defaults as we work our way through this pandemic, and I'm excited to be there. It was a brand I dedicated a lot of time and energy to building back in the day, and have a chance to relaunch it now under new ownership is kind of exciting.
That's fantastic, Rick. Congrats on that. I like it. It's a new
Thank
old
you.
job. That's fantastic. So, Rick, why don't we start here? Okay, so another day, another report. Home prices are high, inventory is low, mortgage rates are low, right? It feels like the same story, and this is not true in every single pocket of this country. I've talked to some agents in the South, for example. There's some markets that are a little bit more balanced, but most of the country is experiencing this. And then we look at unemployment, and we look at the moratorium on foreclosures and evictions and things like that. It's really hard actually to make sense of these two things, especially when the stock market is up and then down and then up again, and it's an election year. So there's a lot of ingredients to what's happening right now. So love for you to take a few moments and just give your perspective across sort of this myriad of issues that we're seeing, and what's going on.
You didn't tell me this was going to be a 2-day seminar.
I know, right? It certainly could be.
So there are a lot of moving parts. You're absolutely right. And because of the pandemic, this is not a typical cycle. Normally, if you see 55 million people file for unemployment, you're going to have devastation in the housing market. And for a whole variety of reasons, and there are a host of reasons, we don't expect the fallout for home ownership to be as bad as you would expect in a normal cycle.
Mm-hmm.
There are a number of reasons for this. One, just to cover a couple, the unemployment numbers in this case have been very heavily skewed toward renters, not toward homeowners. The job losses have all been very, very heavily oriented toward service industry jobs, retail, restaurants, travel and tourism, entertainment, hospitality. The workers in those industries tend not to be very highly paid. They tend to be younger, they tend to be a little less educated, and for all those reasons, they tend to have very low home ownership rates. So a lot of the devastation, if you will, in terms of the job losses, have really been skewed more toward renters than homeowners. And so we haven't seen the kind of fallout we would normally expect in a recession that was caused by an economy that was slowing down. Our economy was hitting pretty much on all cylinders before the pandemic got here. And so it's sort of an artificially induced recession, if you will. And again, the hope is that we see the economy start to bounce back this quarter and in the fourth quarter, and indications are that it's doing just that. So the unemployment claims, generally speaking, have been coming down on a week-over-week basis. A blip here and there, but generally going in the right direction. Still very, very high. The continuing claims for unemployment, more importantly, have been going down week over week. And so the job creation numbers are coming up a little bit as some of those industries reopen and people get rehired. So the hope is that while this was a very, very sharp drop and a very, very severe recession, it turns out to be a relatively short one, and people can get back to work sooner than later. We're already down, and this sounds bizarre, but we're already down to about 10% unemployment,
Right.
Which is 3 times where we were before the pandemic hit. But still, we've come down 50% since the peak of the unemployment rates, and so there's a lot going on. Government intervention is also going to prevent some of the worst case scenarios from taking place. Just recently, the administration worked with the Center for Disease Control, of all people, to put together an eviction moratorium for renters who earn less than $99,000 a year based on health concerns. So you're seeing the government get kind of creative, trying to keep people in their homes, or in this case, keep them in their apartments, and prevent the bottom from falling out of the market. And so far, that's been the case. And in the meanwhile, this is one of those good news, bad news scenarios. The bad news is, because of the way this recession is hit, it's actually sort of increasing the divide between the haves and the have-nots. And the only good news I can give you out of that is that the people who've kept their jobs are really in a good position to be able to continue looking at buying their house or buying their next house. And the pandemic has actually accelerated a couple trends we were already seeing, like people migrating from being urban renters to suburban homeowners.
Right.
And we're seeing that happen pretty quickly in some of the bigger areas like New York and San Francisco. So just so many things going on. And as the millennial cohort ages into prime home buying years in very, very large numbers, that in itself will drive demand. It gets fueled by these historically low interest rates. And most markets are having a hard time keeping up with the demand because there's simply not enough existing home inventory on the market. You mentioned some markets in the South are a little bit more balanced. And that's in part because the builders have been more active in the South than some of the other regions over the last 3 or 4 years. So there's at least a little bit more new home inventory there to offset some of this demand.
That's really interesting, Rick. No, that's a great overview. One of the things that just personally I hadn't really thought about is what you just mentioned, which is, I've talked to lots of people about this migration, right, from tier 1 urban markets to other states, the outskirts. Apparently it's impossible to buy a home in Lake Tahoe right now, right? Because all of the wealthy Silicon Valley elite, are migrating to Lake Tahoe. But what I didn't consider in that, just personally, Rick, is that a lot of the people who lived in those tier 1 urban markets were renters. And that when they leave that market because they took, a solid salary with them and maybe a tech or a finance job, whatever they're doing, that they actually then become homeowners in their new market. So that's actually a facet of this that I hadn't really thought about. Let's talk a little bit about this. So Adam Data Solutions, right, which is the parent company, right, of RealtyTrac, in their, I guess your Q3 2020 zombie foreclosure report, right, talked about nearly 4% of homes facing possible foreclosure. So first and foremost, what the heck is a zombie foreclosure? And what does that really mean? And you talked about this maybe not being as bad as we thought, but again, this is a crazy cocktail of events, right? So let's talk a little bit more specifically about zombie foreclosures and what that might mean for the market.
Yeah, and I would like to circle back on the general foreclosure topic, Randy,
Please.
because I think there's I think there's a lot of misinformation out there about just how bad the wave of foreclosures could be this time, and I'd like to try and calm things down a little bit there. But zombie foreclosures are a subset of the market, and the categorization really for zombie foreclosure is it's a property that's stuck somewhere in the foreclosure process that has gone on for so long that the homeowner, the borrower, has abandoned the property. And so they're no longer there to maintain the property. But because it's still in foreclosure, technically, the mortgage servicer or the lender doesn't have ownership of the property yet. So it's sort of in limbo. It's this sort of Night of the Living Dead model of a property that
Right.
nobody's responsible for. And it becomes an immediate concern in terms of blight. And vacant properties have always been a safety hazard in their neighborhoods. I've been saying that it's more of a hazard today because of the pandemic, simply because you don't know what might be happening in some of those vacant properties while we have a very contagious virus floating around. Um, the forbearance, not the forbearance programs, but the moratoria that the federal government, that state and local governments, and that some of the lenders and regulators have put in place has actually stalled the process of foreclosing on a property that started prior to the pandemic. And the longer a property gets stuck in this foreclosure process without the process ending, the more likely it is to become vacant. And the more of these sort of zombie foreclosure properties we're going to have. So there were about 250,000 properties in some stage of foreclosure prior to the pandemic hitting. And that's, by the way, that's toward the low end of what we've seen historically for foreclosures. Historically, about 1% of loans are in foreclosure at any point in time, and 250,000 properties represented about 0.5%. So we were running at about 50% below normal levels of foreclosure activity. That's how strong the economy and the housing economy was. But those 250,000 properties that were being foreclosed on have basically been frozen in place. And in a lot of those cases, you have borrowers who just are ready to move on and aren't fighting a foreclosure anymore. They were kind of waiting for the final verdict to take place so they could move on. And a lot of them have just moved on rather than wait interminably, whether they had an opportunity to go elsewhere or really just got tired of living under that kind of stress. So it's a problem that could be resolved if state and local governments would allow for an exception to these moratoria in the case that a property is clearly been abandoned and is now vacant, allowing those properties to get through the foreclosure process so that an investor or a home buyer can purchase that property and put it back into use.
Rick, so just so I'm clear, right? This is, though, completely independent and separate of people who are in some stage of forbearance, right? That's not the same thing, right? So let's talk about that piece of it, because that's an interesting component. And maybe you know the latest data, right? It's sort of been on the decline, I think, which is good. But we don't know the end result of that as well. So when you combine the two, just how should people think about the forbearance side of this picture?
I'm actually kind of bullish on what we're going to see in terms of the outcome of this forbearance program. It is doing precisely what it was designed to do in the first place, which is to give people who are in a short-term or at least hopefully non-permanent financial difficulty a way not to go into default. And this is a fundamental difference from where we were during the Great Recession. During the Great Recession, we had millions of people default. And once somebody's in default, really, really hard to work with them and correct things. Much easier to work with somebody by keeping them out of default in the first place. The projections for the forbearance program were just silly in the beginning. There was an economist on the East Coast who was predicting that 25 to 30% of borrowers would go into forbearance.
Right.
That would have cost the servicing industry roughly $90 billion over 6 months, which would have bankrupted the industry and made it just about impossible for anybody to get a loan. Instead, we see that the percentage of borrowers in forbearance looks like it peaked at a little over 8%. As the most recent statistics I've seen, we're down to about 7.2%. And the peak came at the end of March when April payments were due for mortgages. And I would submit to you, Randy, that if the situation were getting worse, we would have seen a similar spike at the end of April, at the end of May, the end of June, the end of July, the end of August. And instead, what we've seen is every week, fewer and fewer people are in this forbearance program. We've also seen a couple other things that are very interesting if you're trying to project how this all plays out. 26% of the borrowers in forbearance have yet to miss a mortgage payment.
Right.
These are people that have been in a forbearance program for 90 or 120 days who have not had to make a mortgage payment, but have yet made one every month. There was a lending tree survey that was done that suggested that between 70 and 80% of the people in forbearance didn't necessarily need the forbearance. They'd sort of taken the program, gotten into the program as a hedge just in case their financial situation did go sideways. So 25% of them making their payments. The other statistic I'd leave you with is that of the people rolling out of forbearance, and there are a lot of people who are going into a second round of forbearance, which again was how the program was designed to work. So you shouldn't be reading anything into that. But the people that are exiting, less than 10% of those are going delinquent. Really? So the ones that are exiting, the loans are being reinstated, the loans are going back to current status. There are repayment plans being put in place. There are loan modifications being put in place, but less than 10% of the people exiting are actually going delinquent. And that's a number to keep your eye on, because that should give you really a better idea of just how vulnerable the borrowers who are in this program really are.
Absolutely. I don't know if impressed is the right word, Rick, but like you said, at the beginning of this pandemic, right, we saw numbers like you just quoted, right, 25% of loans, and even at 8-9% or wherever it peaked, that was still pretty crazy, right? Like that was, nobody had modeled for that, nobody had planned for that. No. And there was a lot of fear about what was going to happen if people were going to be able to get loans, and the industry sort of figured it all out. Now, for most consumers in these forbearance programs, these payment plans you talk about, are these payments being sort of tacked on? They're just extending the loan? Are they amortizing it over a shorter period? Like what's the actual practical impact to someone who's in a program like this?
That's a great question, because normally if you're in forbearance, whatever your deferred payments were are due in full at the end of the forbearance program.
Right.
Now, if mortgage servicers did that this time, we would have millions of foreclosures. There's Absolutely. No question about it.
Nobody has that.
But if your loan is owned by Fannie Mae or Freddie Mac, or if it's insured by the FHA, the rule is that you're to be given the option of tacking the payments on to the end of your mortgage. So your deferred payments aren't due until one of three things happens. Either you term out the loan, which means you completely pay it off in full.
Yep.
You refinance, or you sell your property. So that's when those deferred payments are due for those borrowers. What I've seen in the industry so far is even the loans that are in private portfolios, as the borrowers are coming out, they're working out similar repayment programs, whether it's everything tacked on to the end of the loan term, or it's an adjusted monthly payment that sort of reamortizes that amount over the life of the loan. But so far, nobody that I'm aware of is requiring lump sum payments at the end. So one of the interesting things we're seeing in the forbearance program is there's a surprisingly high number of borrowers who are exiting the program by paying off their loan. So either they're selling their property, or they're refinancing their existing loan, or they're just paying off their loan balance. But one of the things I don't believe anybody expected was that we'd see people exiting forbearance by paying off their loans.
Right.
One of the things that I believe will keep foreclosure numbers relatively low this time around is that we have a record level of homeowner equity in the market, $6.5 trillion of equity. Adams numbers show that 70% of homeowners have more than 20% equity in their properties.
Wow.
So in a market with low inventory, high demand, if you're a distressed homeowner, you have the option of being able to tap into that equity to sell your house rather than to lose it to foreclosure. And it's not a great outcome if you were hoping to hang on to your house, but it's still an outcome where you can exit without a foreclosure. You can put money in your pocket to get started on your next adventure. And it's a much better outcome than the alternative.
Absolutely. Rick, I'm curious. I don't know if you know this number or remember it, but if we think back to '07 going into '08, that 70% number that we're seeing now, do you remember what that was back then?
I don't have a number for you, Randy, but homeowner equity was actually very, very low going into the Great Recession.
I would imagine.
And for two reasons. One, we had lenders who were issuing 100% or 0% down loans on new home purchases. And the other is that a lot of homeowners had kind of tapped into their homes and used them as ATMs.
Oh, yes. That was a huge
And
thing.
they basically gobbled up all the equity, and lenders really were letting them go down to 0% equity on these refinance loans. One of the great underreported trends of that lesson is that the worst performing loans were not subprime loans. They were cash out refi loans by existing homeowners who had kind of over leveraged themselves. So when the market turned, you had an enormous number of homeowners with 0% equity. And it became a sort of an accelerant that created that whole ferocious downturn.
It was crazy to me how commonplace it was to see people, as you said, using their home as a credit card and buying ridiculous things that were not assets or quickly depreciating assets like a car, for example, right? And that culturally, we seem to have left that in the dust, right? So, which is nice. So that is encouraging. You said $7 trillion in equity, and 70% of homeowners have equity in their home?
$6.5 trillion, but
$6.5 trillion. What's $500 billion between friends, right?
These days,
exactly. Yeah, that's a very good point. There's one other question I wanted to ask you, Rick. This is a little bit in the weeds, but I was looking at some of the data from the zombie report. I just have to call it a zombie report. It's not a funny topic, but it's just such a fascinating name. And there's a piece of data in there that says among 158 metropolitan areas with at least 100,000 residential properties, the highest zombie foreclosure rates include, and this list is Peoria, Illinois, Wichita, Kansas, Kansas City, Missouri, Omaha, Nebraska, Cleveland, Ohio, which to me feel like maybe more manufacturing centric, right? Or, other types of things like that. And by contrast, if you look at places with 500,000 and the lowest rates, you see LA, you see Philadelphia, you see San Francisco. So help me understand that a little bit, because when we talked about before the fact that most of the people who are out of work, or many people out of work, are lower income service-oriented jobs, which makes sense. Restaurants close, there's no work for you. Has that impact extended into more manufacturing or farming environments? And can you explain that data a little bit?
Yeah, that's a really good question, Randy. The thing you have to remember is that a zombie foreclosure is likely to be a property that's been in foreclosure for an extended period of time. Okay. So people that have recently lost their jobs probably aren't in foreclosure yet. So this isn't the current recession exacerbating a problem for those people. This is the current moratoria extending the length of time a property that was already in foreclosure remains in foreclosure.
Right.
And the markets you talked about are not unusual in terms of the highest rates, because they're Midwestern areas, which have not always recovered as fully as some other parts of the country economically. And where you also probably don't have quite as much demand for home purchases as you do in some of the coastal areas.
That makes sense.
So those two factors really weigh into the third factor, and this is inside baseball sort of stuff. A lot of judicial foreclosures as opposed to non-judicial foreclosures, which means the foreclosures have to go through the court process, which takes longer and can drag things out interminably, especially dynamic when courthouses are closed. So it's sort of all of these things layer on top of each other to make the problem that much worse.
Yeah, absolutely. No, that makes sense. Rick, the great conversation. This is really helpful to get your perspective. It sounds like, and correct me if I'm wrong, it sounds like you're somewhat optimistic, and whether that's in comparison to '08, right, which I think some people are afraid of, right? Are we on the verge of another massive crash? But given the $6.5 trillion in equity and the fact that, I mean, you said 70% of people have equity in their homes, maybe not be a great option, but it is absolutely an option, right, to stave off some of these foreclosures and things like that. It sounds like you're somewhat optimistic in general. Is that correct?
Yeah, cautiously optimistic, but yeah, I am optimistic. And what most people who kind of lived through the Great Recession probably don't know, because it's the trend I'm going to refer to is older than that. Outside of the Great Recession, the most common way for a distressed homeowner to exit their property was a sale prior to the foreclosure taking place. So about 50% of the time when a homeowner goes into default, they sell their property before the foreclosure auction happens.
Right.
And that normally is what happens. And it's again, not the perfect situation, but it's a better scenario than a foreclosure. And that didn't happen during the Great Recession for all the reasons we talked about. But there are so many differences this time compared to where we were in 2008. Loan quality, just for example, much, much better. We were talking about only 0.5% of people being in foreclosure prior to the pandemic. We're talking about record levels of equity at the peak of the downturn last time. 30% of homeowners were upside down or underwater on their mortgage. So it's the market conditions couldn't be any more different if we tried to make them different. And again, that huge pent up demand of buyers looking for homes is one of the strongest defenses against the downturn.
It makes so much sense, Rick. I mean, so I have the benefit as the host of this show of putting things in layman terms, primarily for myself, if I'm being honest, right? But if I think about this equity situation, just practically, so let's say that I was in a situation and I had I'm making up these numbers, I had a $500,000 house, right? And I lost my job and I was in a forbearance program and I didn't feel like my job was going to come back or I could get an equivalently compensated job, but I have some level of equity in my home. I would sell my house, and it's a great market in most markets to sell right now. I'd get top dollar for that house, and then I'd buy a less expensive house, and I'd probably be okay. Like, does that make sense? Just very practically speaking, it feels like, to your point, it's a very different situation than it was a decade ago.
That's the best way to characterize it, Randy. And that's exactly how the scenario works. You buy a less expensive house, you rent for a while until you're back on your feet. And one of the reasons I am hopeful is that the forbearance programs are as long as they are, and it can last for a year. Somebody who went into forbearance this March could still be in forbearance next March, and that gives both the economy and that individual time to get back on their feet. And then the repayment plans are so forgiving. You literally don't owe that money when you come out of forbearance. You go from being a year delinquent to being current day one. And that year's worth of payments gets tacked onto the end of your loan. So all the criteria are in place to help that homeowner successfully exit forbearance. We just have to hope the economy comes back strongly enough so that many of them are able to do that.
It makes sense. So I have to ask this question. I didn't ask it before because it's in the weeds, but if people are still with us right now, they're willing to tolerate the weeds, Rick. So help me understand this one point I haven't been able to wrap my head around. So these servicers, right, this isn't their bank account, right? They have investors, and those investors have been promised a return. They're investing for a reason, and some of those investors are massive companies, big pension funds, whatever. Like, there's lots of people who invest in these types of things. So when this all happened and they're like, okay, I've got a portfolio and, I'm making up these numbers. 5% of my loans are now, we're going to tack on a year at the end of it, right? And for this year, we're going to call it a wash. Did everybody just go, okay, cool, like, I'd rather have that than a foreclosure, so I'll take the loss? Like, there's so many downstream impacts. I really don't understand what happened to the flow of investors there and what they were promised.
Okay, so a couple things. One is, keep in mind that 65% of the loans out there are government backed.
Mm-hmm.
So right off the bat, you're only talking about a third of the loans
Good point.
meeting the criteria you're talking about. A certain percentage of those loans are still sitting on the portfolio of the lender. So they're not actually owned by a third party either.
Okay.
And those lenders tend to be big depository institutions who are heavily regulated and would probably rather not tweak any of the government regulators that they have to deal with on a regular basis.
Mm-hmm.
So it's a relatively small percentage to begin with. There are two things to consider from that point for these loans. One is that in many cases, the servicers are still making payment advances to those investors.
Okay.
And that was one of the reasons, and this is really inside baseball, but that was one of the reasons there was a lot of discussion in the industry about the need to provide some sort of liquidity source for servicers to tap into so they could continue to make those payments, which they're contractually obligated to do.
Mm-hmm.
So Ginnie Mae has a multi-trillion-dollar credit facility available. And so for those kinds of loans, you're seeing some relief.
Okay.
The other is a point you kind of made in passing in your question. If an investor is reasonably comfortable that a borrower is going to get back on his or her feet at the end of this forbearance program, it's a much easier pill to swallow than what they're going to have to go through in a foreclosure.
Mm-hmm.
For all of the consumer groups who are railing about how the evil banks were taking back people's houses and profiting at their expense, nobody makes money on a foreclosure.
Nobody wanted that. Yeah.
So the potential loss in terms of having to go through in most states is at least a year-long foreclosure process, and then coming out the other side and probably selling something at a loss. A much worse outcome if you're just looking at it practically than working with that borrower for a while and hoping they come out on their feet.
Makes perfect sense. Thank you, Rick, for clearing that up for me, and for anyone listening. I hope that was helpful as well. Rick, I guess we can wrap today. This was a great conversation, as it always is. I love your perspective on this. I like your cautiously optimistic perspective, which is rooted certainly in the data that you're seeing. And so I think that's something that's really important to pay attention to. Is there anything that I missed, Rick, that you wanted to talk about today?
No, I should put a disclaimer on all this. I don't want to come across as completely Pollyannish. You can't have 55 million people file for unemployment and not expect to see an increase in delinquencies and defaults. It's just that I'd encourage people to take a step back, take a deep breath, and realize that there's a lot being done to try and bolster the home ownership and the homeowners that are out there in various stages of distress. And so I think expecting a repeat of 2008 is probably not going to happen.
Yeah. No, I appreciate that disclaimer, Rick. I don't think I've never believed you to be someone with just rose-colored glasses walking around thinking everything is fine, right? Your perspective is rooted, as it always has been, heavily in a tremendous amount of data, and we all do our best to piece that together in a way that allows us to give an informed perspective. And I appreciate you sharing that with us today.
My pleasure, sir, and love to do it.
All right, Rick. Well, hopefully we get to see you again real soon.
Take care, Andy.
All right, Rick. We'll talk to you soon. Okay, well, there you have it. Love having Rick on. He's such a great guest. He's so knowledgeable and has all of this information about what's going on the mortgage side and the housing market and, gosh, just sort of everything. So I hope you enjoyed that. If you missed, again, the previous episodes that Rick was on, it was episode 17, Developing Competitive Advantage, and episode 59, Work from Home's Impact on Real Estate. We'll link to those. Definitely check those out. And that's it. Until tomorrow, be safe, be healthy, be happy, and we'll see you soon. Bye.